Welcome to Charged Alpha. I'm Hudson Thomas, joined by Lana Chen. Today's company chapter, Vertex Pharmaceuticals.
Vertex was founded in 1989 in Boston with a bold thesis: use structural biology to rationally design drugs that target disease mechanisms, not trial and error.
The first breakthrough came in 2012. Calidaco was the first drug ever approved to treat the underlying genetic cause of cystic fibrosis, not just symptoms.
Trikafta extended that platform further. The triple combination therapy now reaches over 92,000 patients in more than 40 countries and covers 90% of the eligible CF population.
That CF monopoly generates extraordinary financials. Trailing 12-month revenue is $12 billion with an 87% gross margin, numbers most pharmaceutical companies never come close to achieving.
Q1 2026 revenue came in at $2,987 million, up 7.8% year over year. Growth is moderating naturally as most eligible patients are already identified and treated globally.
Vertex came in slightly below estimates. EPS was 46 cents versus the 23 consensus, a 4% miss. Revenue missed by 0.2%. The stock pulled back modestly.
Operating margin was 38.1% GAAP. Net income cleared $1 billion in a single quarter, a threshold that only a handful of biotech companies have ever crossed.
The balance sheet is pristine. Vertex holds $5.1 million in cash with essentially zero long-term debt, a rare and powerful combination of profitability and financial flexibility.
The next major growth driver is suzetrigine, also called VX548. It is a non-opioid NaV1.8 sodium channel blocker that received FDA approval in January 2025 for acute pain.
The non-opioid positioning matters enormously. Hospitals and payers have strong financial and regulatory incentives to adopt alternatives. The acute pain market is several times larger than CF.
Casgevy is the third pillar, co-developed with CRISPR Therapeutics. It is the first CRISPR-based medicine ever approved by the FDA, targeting sickle cell disease and beta thalassemia.
The broader pipeline adds chronic pain, kidney disease, and alpha-1 antitrypsin deficiency programs. Vertex is methodically building its post-CF revenue base across multiple therapeutic categories.
The primary risk remains Trikafta's eventual patent exposure. CF exclusivity extends well into the next decade, but any generic entry or competing drug would create significant revenue pressure.
CEO Reshma Kewalramani earned her MD at Harvard Medical School and joined Vertex as Chief Medical Officer in 2017, before being elevated to CEO in 2020.
Her approach is physician-scientist first. Patient outcomes drive decisions ahead of commercial considerations. That culture explains why Vertex's drug approval hit rate leads the entire biotech sector.
The stock traded near $255 in 2020, climbed to around 510 TES in 2025, and has since pulled back to approximately $430. Investors want proof that post-CF growth is real.
The market is essentially asking one question: can suzetrigine scripts and CAS patient conversions accelerate before CF market saturation creates a revenue ceiling? The answer unfolds this year.
The two numbers to track are suzetrigine weekly prescription volume and Casgevy patient conversions. Those metrics will define Vertex's next growth chapter more than any other data points.
Vertex holds the cystic fibrosis market the way few companies control any disease category. Now it is building chapter 2 in pain and gene therapy. That is your Charged Alpha chapter.
Vertex Pharmaceuticals posted its first earnings miss in recent memory, and the market has questions. Revenue of nearly $3 billion, a tiny top-line shortfall, and an EPS miss of 4%. But underneath the headline numbers sits one of the most durable drug franchises in biotech and a pipeline that could define the next decade of the company. This is Charged Alpha. I'm Hudson.
And I'm Lana. Vertex Pharmaceuticals is a Boston-based biopharmaceutical company best known for dominating the cystic fibrosis treatment market. Their Trikafta franchise treats the underlying genetic cause of cystic fibrosis in patients with at least one F508del mutation, which covers the vast majority of the CF patient population. Over 92,000 patients across 40 or more countries are now on Trikafta globally.
Beyond cystic fibrosis, Vertex has been aggressively expanding into new disease areas. Suzetrigine, branded VX548, received FDA approval in January 2025, as the first new non-opioid mechanism for acute pain in decades. Casgevy, developed in partnership with Bluebird Bio, is a gene therapy for sickle cell disease. Market cap is approximately $110.9 billion, with the stock trading around $430.
Q1 2026 revenue was $2.987 billion, against a consensus of $2.94 billion. A $7 million miss, technically a miss, but a rounding error on a $3 billion quarter. Year over year, revenue grew 7.8%. The absolute top-line shortfall is trivial, but in a market that punishes pharma companies on any shortfall at all, it sets the tone for how analysts frame everything else in the quarter.
EPS came in at $4.06 versus a consensus of $4.23, a 4% miss on the bottom line. That is more meaningful than the revenue shortfall because it suggests either higher than expected operating costs or one-time items compressing earnings in the quarter. Vertex rarely misses EPS, so this print draws more scrutiny than it would at a company with a longer history of mixed results.
Despite the miss, the margin structure is exceptional. Gross margin was 87%, among the highest in large-cap biotech. GAAP operating margin hit 38.1%. Net income was $1.03 billion in a single quarter. The company is generating $1 billion of net income every 90 days from essentially one drug franchise.
Free cash flow is lower than you might expect, given those margins. Trailing 12-month FCF was $348 million, only an 11.7% margin against $3 billion in quarterly revenue. The explanation is massive R&D spend. Vertex is reinvesting aggressively into its pipeline across CF next-generation modulators, sutrigine, and Casgevy, which compresses near-term cash conversion, but is a deliberate strategic choice rather than a sign of business weakness.
The balance sheet is pristine, $5.1 billion in cash, zero long-term debt. Revenue trend, Q1 2025, $2.77 billion, Q2, $2.965, Q3, $3.076, Q4 3.227. The Q1 2026 print of 2.987 is the first sequential decline in several quarters, a data point the street will watch closely.
At 9 times PS and a forward PE of 24, Vertex is priced as a premium compounder. 24 times forward earnings is defensible for a company with 87% gross margins and a near monopoly in chronic disease. The debate is whether pipeline execution can sustain that premium as the CF franchise eventually faces patent pressure.
Analyst sentiment is constructive. By consensus, average target $495 against the current price of $430. That is 15% implied upside. The miss may cause near-term target trimming, but the core thesis remains intact for most analysts on the street.
The bull camp emphasizes that the CF franchise is not just durable, it is still growing. Vertex continues adding new patient populations in markets that were not previously accessible, expanding geographically into regions where Trikafta is only beginning to penetrate and advancing next-generation modulators. The argument is that the 2037 patent cliff is far enough away that near-term fundamentals dominate today's valuation, and the pipeline optionality sitting on top of that is essentially free at current prices.
Suzetrigine is the wildcard analysts are watching most closely. Acute pain is one of the largest drug markets in the world, and VX548 is the first genuinely new mechanism approved for it in over 2 decades. The NAV 1.8 mechanism is clinically differentiated from anything currently on the market. If prescription adoption accelerates through 2026, it could become a billion-dollar product on its own. Early uptake has been slower than the most optimistic projections, but the street is not writing it off, not yet.
Bears on the street point to the sequential revenue decline and ask if CF is approaching saturation. If most eligible patients in key markets are already on therapy, future growth depends on label expansions and new modulators, a different narrative than the rapid enrollment story of the past 5 years.
There is also the EPS misread-through. R&D expense has been climbing as Vertex advances multiple pipeline programs. If those investments do not yield approvals on schedule, the street will question whether R&D spend is generating adequate returns. One miss does not make a trend, but it reopens the conversation.
The bull case centers on revenue diversification. Trikafta has been a single product story, and now Vertex is building a second. Suzetrigine targets a massive unmet need with genuine political and regulatory tailwinds. Payers and physicians are actively seeking opioid alternatives, and AV1.8 blockade has real clinical differentiation.
The $5.1 billion cash position is a strategic weapon. Vertex has firepower to acquire mid-stage biotech assets and expand the pipeline fast. Zero debt means they can deploy aggressively. A well-targeted bolt-on in rare disease or specialty pain could meaningfully extend the long-term addressable market.
And the 87% gross margin is structural, not cyclical. Every incremental revenue dollar that comes in flows almost entirely through to operating income. When suzetrigine scales and next-generation CF modulators launch, the financial operating leverage is enormous. High gross margins are the fundamental compounding engine in pharma, and Vertex's are among the best in the entire large-cap space.
The patent cliff is the structural overhang. Trikafta's U.S. patents expire in 2037, 11 years away, but in biotech time that shapes capital allocation decisions and pipeline urgency right now. Generic CF entry after 2037 could dramatically erode franchise revenue unless next-generation modulators carry their own robust patent protection. Management is working on a successor compound, but regulatory and patent outcomes are never guaranteed.
Suzetrigine adoption has been slower than the most bullish projections. The acute pain market is dominated by cheap generic opioids, and cost remains the primary driver of prescribing decisions, regardless of mechanism. Payer coverage decisions, formulary placement, and physician education all take time to play out. If the ramp stretches years rather than quarters, the second revenue stream thesis gets pushed out meaningfully.
The Q1 sequential decline raises a question. Is CF growth flattening? Q4 was $3.227 billion. Q1 came in at $2.987. That is a 7.5% sequential decline. Seasonality likely explains some of it, but if Q2 does not recover above Q4 levels, analysts will model a flatter core business trajectory.
Competitive pressure in pain is real. Eli Lilly, Pfizer, and several biotechs have non-opioid programs in adjacent pathways. First-mover advantage matters, but in a category this large and commercially contested, it does not guarantee market share, especially against companies with larger commercial infrastructures.
Against large-cap biotech peers, Regeneron, ticker REGN, posted negative 7.2% revenue growth and trades at 5.4 times PS. Regeneron is absorbing intense Eylea biosimilar competition, a more acute and immediate franchise pressure than anything Vertex faces today. The lower REGN multiple reflects that near-term revenue headwind directly and makes it a poor apples-to-apples comparison.
Biogen, ticker BIIB, grew 8.7% but trades at only 2.3 times PS. Biogen is cheap for a reason: inconsistent pipeline execution and a core MS franchise in structural decline. Vertex's premium to Biogen is justified by the CF franchise's durability and the balance sheet's cleanliness.
Alnilam, ticker ALY, is the most interesting comp. 6.4% growth, but the stock trades at 11.4 times PS, a premium to Vertex. The market is paying even more for Alnilam's RNAi pipeline optionality than for Vertex's proven cash generation, which tells you something about how the street values early-stage promise versus established franchises.
The peer set puts Vertex in a reasonable spot. Better near-term stability than Regeneron, vastly superior margins to Biogen, more proven cash flow than Alnilam. Not cheap but not overextended given franchise quality. 9 times PS sits comfortably in the middle of the large-cap biotech valuation spectrum.
The options market is neutral on Vertex. Put-call ratio sits at 0.85, higher than Sterling's bullish sub-0.7 reading. Near 1 is balanced, reflecting genuine uncertainty after the miss. VX548 launch traction is the key near-term catalyst the options market is pricing around.
The options flow to watch is anything tied to suzetrigine prescription data. Weekly scripts are reported through IMS Health, and traders are tracking early VX548 fills closely. If call buying accelerates on a positive weekly script beat, that would be a meaningful confirming signal that the launch is gaining traction faster than the base case.
Insider activity has been quiet. No open market purchases in the recent filing window. What we see is routine executive option exercises, converting vested grants to shares, standard compensation activity with no directional signal. The absence of insider buying at 4:30 does not raise alarms, but it does not add conviction either.
One structural dynamic worth noting: Vertex carries significant index weight across S&P 500 and biotech ETFs. Passive flows create a consistent bid as the company grows earnings and index weights get rebalanced upward. That mechanical support does not show up in options data, but is a real floor under the stock, especially relevant when you are assessing downside risk at a $110 billion market cap.
Vertex is a high-quality compounder that hit a speed bump in Q1. CF franchise intact, margins elite, $5.1 billion in cash, zero debt. Not a broken story. A premium company that briefly showed a crack, and the market will watch Q2 to see if it closes.
For long-term holders, the thesis is durable. For traders, watch weekly VX548 script fills. If suzetrigine accelerates through the back half of 2026, the bear narrative fades and the path back toward 495 becomes clear.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.